China is the world's largest consumer of copper, accounting for about half of the global demand. Copper is widely used in various sectors of the economy, such as construction, electronics, power generation, and transportation. However, China's manufacturing sector is facing a severe challenge due to power restrictions and plant maintenance, leading to lower demand for copper. One of the main reasons for the power crunch is the soaring price of coal, which accounts for about 60% of China's electricity generation. Coal prices have surged to record highs due to a combination of factors, such as strong domestic demand, tight supply, import restrictions, and environmental regulations. The Chinese government has imposed strict limits on coal consumption and emissions to meet its carbon neutrality goals, forcing some provinces to ration power and shut down factories. According to official data, China's manufacturing activity contracted in September for the first time since the COVID-19 pandemic began. The Purchasing Managers' Index, PMI, fell to 49.6, below the 50-point threshold that indicates expansion. The PMI survey also showed that high-energy businesses, such as metal smelting and processing, have not been prospering. The power shortages have hit hard on China's industrial heartlands, such as Jiangsu, Zhejiang, and Guangdong, where many copper-intensive industries are located. These provinces have ordered factories to limit their energy consumption or suspend production for certain periods of time. Some factories have also reported delays in raw material deliveries and finished product shipments due to the power cuts. The power crisis has also affected China's semiconductor industry, which relies heavily on copper for wiring and interconnects. China is the world's largest importer of semiconductors, but also aims to boost its domestic production amid geopolitical tensions and supply chain disruptions. However, the power restrictions have hampered the operations of some chipmakers and fabs, threatening to worsen the global chip shortage. The impact of China's power crunch on the global copper market is already evident. The price of copper has fallen by about 15% since its peak in May, as investors anticipate weaker demand from China. The International Copper Study Group, ICSG, has also revised down its forecast for global copper demand growth this year from 5.1% to 4.7%, citing China's slowdown as a major factor. The outlook for China's copper demand remains uncertain, as it depends on how long and how severe the power crisis will be. Some analysts expect the situation to improve in the coming months, as coal supply increases and winter demand eases. Others warn that the power crunch could persist or worsen, as China faces structural challenges in balancing its energy needs and environmental goals. Copper is one of the most widely used metals in the world, thanks to its high conductivity, durability, and versatility. It is also a key component of the green energy transition, as it is essential for electric vehicles, renewable power generation, and grid infrastructure. However, despite the strong long-term demand outlook for copper, its prices have been sliding in recent months, due to a combination of factors that have created a bearish sentiment in the market. One of the main reasons for the copper price decline is the apparent weakness in China, the world's largest consumer of the metal. China accounts for about half of the global copper demand, and its economic slowdown has weighed on the metal's prospects. China's manufacturing sector has been contracting for several months, as it faces headwinds from trade tensions, environmental regulations, power shortages, and debt problems. As a result, China's net imports of refined copper have fallen by 16.4% in the first quarter of 2023 compared to the same period last year. Another factor that has put pressure on copper prices is the expectation of a supply surplus in the near future. The global copper market has been in a deficit for the past 2 years, according to the International Copper Study Group, ICSG, which estimates that there was a shortfall of 431,000 tons in 2022 and 114,000 tons in 2023. However, the ICSG also projects that the market will return to a surplus of 155,000 tons in 2024, as new mine projects come online and existing operations ramp up production. This anticipation of a supply glut has dampened the enthusiasm of investors and traders, who have reduced their exposure to copper futures and options. However, some analysts argue that the copper supply surplus is proving elusive, and that the market will remain tight for longer than expected. They point out that copper mine supply has been plagued by disruptions, delays and cost overruns, due to various challenges such as COVID-19 outbreaks, labor disputes, social unrest, environmental issues and technical difficulties. For example, Chile, the world's top copper producer, has seen its output decline by 3.5% in 2022 and 1.9% in 2023 due to strikes, protests, and water shortages. Moreover, they contend that copper demand will continue to grow faster than supply in the coming years, driven by the electrification trend and the recovery of other end-use sectors such as construction, electronics, and industrial machinery. The mismatch between copper prices and fundamentals has implications for the profitability of copper producers and smelters. On one hand, lower prices mean lower revenues and margins for miners, who have to cope with rising costs and declining ore grades. On the other hand, lower prices also mean lower treatment and refining charges, TC/RCs, for smelters, who have to compete for scarce concentrate supplies from miners. TC/RCs are fees paid by miners to smelters to process their ore into refined metal, and they are usually inversely related to copper prices. According to Fast Markets MB, spot TC/RCs have fallen to their lowest level since 2011, indicating a tight concentrate market. In conclusion, copper prices are sliding despite a long-term projected supply deficit, and this affects the profitability of copper producers and smelters. The main reasons for the price decline are the weakness in China's economy and the expectation of a supply surplus in 2024. However, some analysts believe that these factors are temporary or overstated, and that copper demand will outstrip supply in the long run. Therefore, they expect copper prices to rebound once the market sentiment improves and the fundamentals assert themselves. China's slowdown is not only affecting the global copper market, but also other metals markets, such as iron ore, aluminum, and nickel. These metals are widely used in various industries, such as construction, transportation, manufacturing, and energy. In this section, we will explore how China's slowdown is impacting these metals markets and what this means for the global economy. Iron ore is one of the main raw materials for steel production, which is essential for building infrastructure and machinery. China is the world's largest consumer and importer of iron ore, accounting for about 70% of global demand. However, China's iron ore imports have declined by 10% in the first 5 months of 2023 compared to the same period last year. This is due to several factors, such as China's crackdown on steel production to reduce carbon emissions and pollution, China's cooling property market, which reduces the demand for steel-intensive construction, China's shift to higher-quality iron ore to improve efficiency and reduce emissions, China's trade tensions with Australia, the largest supplier of iron ore. The decline in China's iron ore demand has led to a sharp drop in iron ore prices, which have fallen by more than 50% since their peak in May 2021. This has hurt the profitability of iron ore producers, especially in Australia and Brazil, which rely heavily on exports to China. It has also affected the economies of some developing countries, such as South Africa and Peru, which depend on iron ore exports for their foreign exchange earnings. Aluminum is another metal that is widely used in various sectors, such as packaging, transportation, electronics, and aerospace. China is the world's largest producer and consumer of aluminum, accounting for about 55% of global output and 60% of global demand. However, China's aluminum production and consumption have also slowed down in 2023 due to several reasons, such as China's power shortages and rationing, which have forced some aluminum smelters to cut or suspend production, China's environmental regulations and carbon targets, which have increased the cost of aluminum production, China's weaker domestic demand for aluminum products amid slowing economic growth, China's export restrictions and tariffs on some aluminum products to curb Oversupply and support domestic prices. The slowdown in China's aluminum market has led to a decline in aluminum prices, which have fallen by about 20% since their peak in July 2021. This has affected the profitability of aluminum producers, especially in China, where many smelters are operating at a loss or near break-even levels. It has also impacted the global aluminum supply chain, which relies on China for raw materials, intermediate products, and finished goods. Nickel is another metal that is important for various industries, especially for the production of stainless steel and batteries. China is the world's largest consumer and importer of nickel, accounting for about 50% of global demand. However, China's nickel consumption has also weakened in 2023 due to several factors, such as China's reduced demand for stainless steel amid slowing construction and manufacturing activities, China's shift to lower nickel batteries for electric vehicles to reduce costs and dependence on imports, China's diversification of nickel sources to reduce reliance on Indonesia, the largest supplier of nickel ore, China's increased recycling of nickel-containing scrap to conserve resources and reduce emissions. The slowdown in China's nickel market has led to a fall in nickel prices, which have dropped by about 30% since their peak in February 2021. This has hurt the profitability of nickel producers, especially in Indonesia and the Philippines, which are the main exporters of nickel ore to China. It has also affected the development of new nickel projects, especially in Africa and Latin America, which face challenges such as financing, infrastructure, and environmental issues. The slowdown in China's metals markets has significant implications for the global economy. On one hand, it could ease some inflationary pressures by lowering the cost of raw materials and intermediate goods for various industries. On the other hand, it could also dampen some growth prospects by reducing the income and investment opportunities for metals exporters and producers. Moreover, it could also increase some geopolitical risks by creating trade frictions and supply disruptions among major metals players. In conclusion, China's slowdown is affecting other metals markets besides copper in different ways and degrees. The impact of this slowdown will depend on how long it lasts and how deep it goes. It will also depend on how other countries and regions respond to this challenge by adjusting their policies and strategies. Therefore, it is important to monitor the developments in these metals markets closely and prepare for possible scenarios accordingly.